What's up, guys? It's Ricky Analog. I know it's been a minute since we've done an episode of how to dig, but I was putting out content and I realized that this stuff, if it's misused or misinterpreted, can actually get people hurt. So we're going to do an episode today and cover that topic of how to avoid getting killed by fundamentals.
In a zero-sum game, where the stakes are high and they play for keeps, your only means of survival is to find an edge. Filings can uncover hidden landmines, but only if you know how to find them. Knowledge is power. Come along as I try to turn this foreign language into your native tongue. This is How to Dig.
So do fundamentals matter? Yes, emphatically yes, but they often take longer time to play out. Technicals often play out much more near term and should always take precedence. You could be 100% right about the fundamentals, your thesis, their agenda, all the overhead supply levels, everything, and still be early and get crushed. In our business, being early is the exact same thing as being wrong. So, if fundamentals don't necessarily matter in the near term, how and why should we want to use them? Well, for starters, fundamentals are going to help develop a more complete picture of what's actually taking place in the background. Now, while there's actually hundreds of different ways to trade, I'd actually be naive to tell you that my way is any better than anyone else's. But there are some things that just seem to be objectively true. The first is that fundamentals can help you develop a bias. There are certain stocks that make a compelling long and others that are just a dream short. Second, they can help you develop a thesis. So it's my opinion that every microcap out there that has a meteoric or parabolic move actually, and even the price action leading up to it, is actually someone's agenda kind of just playing out in front of us. So fundamentals can help us find clues as to what that agenda may be. Lastly, it can help you have conviction in your thesis. So if technicals and price action confirm that your thesis is actually correct, you can get paid for your hard work. But before we put any of this into practice, we need to first identify the many pitfalls that a lot of beginners make when using fundamentals. Let's start with the very important assumption that should be treated as fact, and that is almost all microcaps are going to have red flags in the filings, especially if you look hard enough for them. They're microcaps for a reason. This can lead to confirmation bias. Realize that things can range on a spectrum from crappy financials and a lousy business model all the way to flat out paper selling scam. The way to combat this, make sure when you're doing your research that you don't have a trade on, no position. If you're already short and you're getting squeezed, that is not the time to run to the filings and start digging frantically. What you're going to end up doing is finding stuff that just confirms your thesis. You're going to find stuff that makes you hold that trade. As it goes against you, you're going to get stubborn, you're going to get hurt. Make sure you're flat. The next issue people run into with the filings is that they're confusing. And don't worry, they're meant to be. These guys wouldn't even disclose this stuff if the SEC didn't make them. But since they have to, they decorate it in all this lawyer jargon, so much so that by the time they're done writing it, I guarantee you they themselves are confused as to what it even says. So this causes huge problems for people new to filings. The first and most obvious issue arising from this confusion is that people often misinterpret what they're reading and come to the incorrect conclusion. I can't tell you how many times I've seen people on Twitter running around talking about stock XYZ has an active ATM, when in actuality all they did was they used Control F to search the filing when they're reading in the shelf and they find the term at the market. But the problem with that is that almost all shelf registrations are going to have a section where they disclose all the different ways that the shelf could be used. So it's not an actual ATM, but yet now you have newbies running around on Twitter telling other newbies there's an ATM. So what happens? Everybody gets short, anticipating a dump that never materializes, and it actually can cause quite a large scale squeeze if too many people all have the same incorrect thesis. What I recommend is not using Control F for the first few months at least when reading filings. Put in the work, do the reading. You gain so much insight from reading the filings, all these nuances and stuff that you're gonna miss if you're just taking shortcuts. Shortcuts will get you killed. The next piece of advice is make sure you Google all terms you don't fully understand. Let me repeat that. Google all terms you don't fully understand. I know there's going to be a lot of questions, and those questions should lead you to more questions, which just takes you down the rabbit hole. But eventually, the questions start becoming less and less frequent, and when you start reading the filings more, things become more clear. No shortcuts, put in the work, read. This leads to the next problem people experience when reading filings. If one word, just one word, is misread, skipped, or misinterpreted, it can change everything. Simple example is if you're reading a prospectus or a prospectus supplement, and you're in the section that's disclosing the MVPHS, there's also going to be the part that talks about the share structure. So there'll be the part that discloses the OS. And there's also going to be a little part that talks about the shares held by affiliates or non-affiliates. Now, I've seen it both ways. Sometimes it may say shares held by non-affiliates. Other times it's going to say shares held by affiliates. Now, do you see the difference? It's subtle, but one of them's telling you the amount of shares that are in the float. The other one is telling you the exact opposite, the amount of shares not in the float. So that one change, that one word missing from that statement changes everything. So one of the reasons we like to use fundamentals is to establish a thesis on the agenda that may be playing out. Now, there are often many agendas that could be playing out, but one of the ones we see time and time again is a company trying to grow their MVPHS in order to increase their shelf capacity. So let's take the example we just did about finding the wrong float and apply it to that. So let's assume we have a company that has an 11 million OS and you have misread it as shares held by non-affiliates is 9 million. But in actuality, what it says is shares held by affiliates is 9 million. So one, let's just get this out of the way. You're actually going to probably have a bit of a disconnect when trading it because it's going to be probably a little more volatile than you had anticipated because you thought it was a 9 million float, and in reality you're trading something that's a 2 million float. So it actually may trade much more differently than what you're anticipating. But that's not even the real problem. Is the agenda that you may come to the conclusion about could be completely incorrect if it's based on the wrong float. So you're going to say maybe they're trying to increase the MVPHS because a 9 million share float, every dollar they close higher, it adds $9 million to their MVPHS, which in turn means another 3 million the company can raise. But if it's really only a 2 million float, maybe that changes the thesis because now it's only growing their MVPHS by 2 million, meaning they can only raise like another 600 and something thousand dollars or whatever on that shelf. So it could negate your thesis. And if you are thinking that they're trying to close it strong, you may avoid a short that might be a layup short. You may even go long on a stock that you think has an agenda to have a strong close, and you may end up at best just missing an easy fade, at worst being long something that just dumps on you because you had the wrong thesis. And remember, this is all stemming just from misreading one word or misinterpreting one thing in the filings, in one filing out of many filings. So you can see how quickly this can go off track. Some of the other things that can be misinterpreted are important dates, conversion prices for derivatives, recent reverse split adjustments, so many things. The way to combat this is to make sure that you read everything extremely carefully. Oftentimes, if you misread something in one filing, something won't add up when you're reading another filing. And it's because it's just going to be in the back of your head, like something's not adding up. And usually it's because you got something wrong in one of the other filings. What you need to do is go back, identify what it was that you got wrong or missed, and try to get that straightened out. Now, if you have other friends or peers that are well versed in filings, you guys can always work as a team to tear something apart, but that comes with a caveat. Make sure that you're doing the research yourself and just comparing notes, because you're not going to pick up all the subtle nuances about a company that you're going to pick up when you actually read the filings if somebody's just spoon feeding you information. They can tell you the price of the derivatives, but they can't tell you all the other small little subtleties that they picked up, whether it was consciously or subconsciously. There's so many things that you're going to gain from reading it yourself. So just make sure you compare numbers. Don't let somebody do your research for you. Do your own digging. There's no shortcuts. So another issue I see people that are newer to filings make is they'll find the prices where the overhead is at, whether it's warrants or convertibles or whatever, and they want to short immediately at those prices regardless, like no questions asked. And in my opinion, that's completely the wrong way to do it. We've already discussed earlier how important your technicals need to be. They need to take precedence. I can't tell you how many times I've seen humongous squeezes way past the prices of warrants and stuff because people shorted in front of that number or even like right at it. It doesn't matter. We have to, let's acknowledge that the people holding the warrants typically want the price higher than the warrants in order to start dumping. Now, depending on how much they have, if it's millions and millions of shares, they actually need the price to do one of two things. They need it way above that price. They need it way above the conversion price with lots of volume as well. Or they need it to go above that price multiple times. It might not just be a one-day thing. So the more they have, you actually need to think maybe they need this quite a bit higher in order to dump all this. So don't just be shorting in front of the warrant exercise price without using your technicals first. So the way to combat this is just as we were saying, use your technicals. Find those levels, use the fundamentals the correct way, which is to find those levels of supply, and then use your technicals to watch it at those levels. Find your entry through the technicals. But make sure you're using the fundamentals to at least identify those levels, those key levels of importance. The last thing I want to touch on is how much emphasis to put on the fundamentals. So we've already established that one of the reasons we use them is to form a bias. But that's a double-edged sword. Oftentimes people get so stuck in their bias that they're stubborn to the point where they'll take a huge loss that should have been cut much earlier, but they can't cut it because they're so biased from reading the filings. I've been there, I've done it. There's companies that are so dirty, so scammy, just so stinky that when you get involved in the trade, if it starts to go against you, you find it so difficult to just eat the loss. But I'm telling you, that's what you need to do. You need to eat the loss. Listen to price action. If you're getting squeezed, it's because you're early. In trading, being early is the same as being wrong. It's okay to be wrong. We've heard this a million times, right? It's okay to be wrong. It's not okay to stay wrong. And fundamentals are oftentimes what cause traders to stay wrong. People get so caught up on, but this stock it's definitely coming back down. It's definitely coming back down. Don't be that guy. There's well-documented cases of people getting destroyed on some of the crappiest tickers. DRYS, MDXG, BPTH. People have just blown accounts on some of the stocks that are just obvious scams. I'm telling you, sometimes the more obvious it is, the more dangerous it is. Use your technicals, people. Don't put so much emphasis on the fundamentals that it gets you killed. That's the main takeaway on this. You need to stay safe. Use the fundamentals to get a bias, but don't be so stubborn that you can't be removed from your position. Let the price action always be king. So now hopefully with these tips in your back pocket, you can go out there, venture into the world of fundamentals and filings, start digging up that dirt, but remain safe. Don't get killed by the fundamentals. Stay safe out there, guys. Keep digging. Until next time, peace.